your same one?
I had to lift mine up.
Oh, you did.
It is 10 o'clock, and we will call the May 8th, 2025 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to receive the election report. We have a motion and a second. Please record your vote. Item is approved. Item number 3 is to approve the meeting minutes from April 10th, 2025. Have a motion and a second. Please record your vote. Item is approved. Item number 4 is we have a presentation from Ernest Partners. Patty, you want to give us a little introduction?
Yeah, good morning. So we have Trey Greer here from Ernest Partners. Just as a quick reminder, Ernest Partners is one of your small to mid-cap managers. So you currently have 2 small mid-cap managers, Silvercrest and Ernest Partners. Silvercrest came in at the last meeting last month. Ernest Partners is here today. They've been managing money for you for a long time, since 2003, and they manage approximately 5% of the overall portfolio, or about $50 million. And they serve as a complement to Silvercrest. So Silvercrest is small cap growth, whereas Ernest Partners is small cap value, small to mid cap value. So they can go up a little bit higher on the market capitalization spectrum. Both are designed to complement one another so that you get broad exposure to the overall small to mid cap market space. So with that, I'll let Trey provide an update on the portfolio.
All right, good morning, everybody.
Good morning.
It's good to see everyone, especially after the big win last night. I always enjoy coming out here and visiting with y'all and seeing my oldest son who lives here. I think I've told you that before, so it's always great to come back out here. I guess, well, I'll move this along. Is that how this, or how does that go? Or I can what now? Oh, okay, I got you. All right, thank you. Okay. All right, well, just to reintroduce myself and kind of my background, my name's Trey Greer. I'm a partner with the firm and a member of the product management team. And I'll start with just a firm update. Nothing to report on the firm front. You know, we continue to be as we've been really since we started managing for you over 20 years ago. So we're an employee-owned firm, which we think brings with it a lot of advantages in terms of just overall motivation of the employees and the stakeholders, in terms of just attracting really great people that want to be an owner in a firm as opposed to just an employee. Just in terms of calibrating risk and return. You know, when you own a firm, you think about not only the return you might get, but the risk you might take. And the risk not only in terms of the stocks you pick for your clients, but also just the way you operate your business. And so the ownership, you know, people have always said, well, it's just a matter of time until you sell out to some big organization. And we've always said, no, that's just not our way. And that continues to hold true. And we've been around now for about 25 years. So no change on that front. No change in terms of the investment process, continue to be a bottom-up fundamental stock picker. So we're not making bets in terms of what we think the economy is going to do or what sector is going to outperform. We're just out there trying to find the most undervalued companies, 60 undervalued companies that we can put together in a diversified portfolio and generate returns over time. And it's a long-term strategy, as you know. If you look at our portfolio year to year, the turnover is about 20%, which is, as your consultant and others will tell you, is very low for a small cap manager. A lot of small cap managers are buying and selling weekly and turning the portfolio over like 100%. That's not who we are. So we really are investors, not traders, and that continues to hold true. And then as far as the team goes, it is a team approach. So there are 10 of us on the investment team that pick securities on your behalf. And it's a collaborative process. We're all responsible for research and then coming together as a team and making decisions. And so that process continues, that team approach continues. So no changes to report overall. Flipping to the next page, I'll just speak briefly to the markets. I'm sure everybody's been following the markets and knows what's going on, but the big drivers of what's going on this year and toward the end of last year is the situation with tariffs and what is going on in that front. No one really knows what's going to go on day to day, and certainly that's kind of driving the mentality of the market. It's driving the volatility of the market. And the concern across the market, particularly with small and mid-cap companies, is the risk of recession. Small cap companies tend to underperform a little bit during times of duress, and so the fears of being a recession is why small cap has continued to kind of lag behind their large cap peers. So that's really what's driving the market. The market, there are few certainties in the market. One of them is the market doesn't like uncertainty, and that's kind of what we're seeing today. But we're starting to see a little bit of that turnaround, but certainly that's what's driving the market. As mentioned, we manage a small to mid-cap portfolio for you, and as I said, small cap continues to lag a little bit. It's surprising in some ways and very expected in other ways. Expected in, as I mentioned, kind of uncertainty tends to impact small cap companies more than large cap companies. But it's unexpected in other ways. One is that it's continued for a long time. So small caps underperform. This is the 5th straight year that small caps lag behind large caps. So that's surprising. These cycles tend to not last that long. It's also surprising in a sense that the valuation continues to be pretty significant. So if you think about historically, small cap companies tend to trade at a premium in terms of a valuation, like a price to earnings basis, because it kind of makes sense. A smaller company has a longer runway, so that it has a long way to go in terms of reaching its potential. So small cap companies have bigger upside. But what we're actually seeing is small cap companies are trading at a significant discount, about 20 or 25% on most metrics. So it's surprising in the sense that that valuation gap continues. But we know from history that it does turn. It's just a matter of when. And it's also surprising a little bit given the state of the tariffs, because tariffs impact all companies, but impact large cap companies more than small cap. Nothing's equal, but all else equal, small cap companies tend to be more focused domestically as opposed to internationally. So they're less exposed to a trade war, if you will. So again, once the dust settles, I think this lot is in small cap's favor, but right now it's simply been kind of out of favor compared to large cap. But you guys know, you've been doing it for a long time. Diversification works and all things change. And so we feel good about small cap going forward. But that's kind of what's going on in the market overall. Let me flip to page 4. The next page, and drill down a little bit just for interest's sake. Again, we're not a bottom-up manager or a top-down manager by any stretch, but sometimes it's interesting to kind of see from a sector perspective what's going on in the marketplace. And here you can see within the Russell 2500 value, which is the pool of securities we choose from, it shows you the different sectors and what's kind of performed year to date, or at least in the first quarter. And it's very interesting that the best performing sector this year is utilities. And utilities was also the best performing sector last year, but for very different reasons. For this year, utilities have outperformed because of the classical reason, which is when things get rough, people go back to the basics. They go back to utilities, they go back to consumer staples. They kind of want to be in those areas where you're going to pay your power bill, whether the economy's up or down. You're going to buy food for your family, whether the market's up or down. And so people migrate back to those areas, and utilities is kind of top of the list. Utilities outperformed last year for a very different reason. Utilities outperformed last year because they were associated with the artificial intelligence boom. So artificial intelligence requires a lot of sophisticated chips. Sophisticated chips require a lot of power. And so everybody was investing in utilities because they were providing the power for all these data centers to run the artificial intelligence models that a lot of us are using every day. So it's interesting to see a sector kind of outperform for 2 straight years, but for very, very different reasons. So again, that's just kind of interesting, not the way we think about how we invest in individual companies, but sometimes it's interesting to see kind of what's performing. And you can see information technology on the other end is the sector that struggled the most. And there's a variety of reasons for that. One is information technology companies tend to have a high beta, and so they tend to go up a lot when the market goes up. They tend to go down a lot when the market goes down. And so when the market goes down, they've lagged, and that's no surprise this year. And then also because of the uncertainty, A lot of technology companies do well when there's a lot of mergers and acquisitions activity, but a lot of companies are kind of sitting on the sidelines right now in terms of acquisitions given the uncertainty in the market. So, that's one of the reasons IT has lagged behind the others. Let me flip forward a couple pages to your results, the most important part. And you can see here the performance for the different time periods. So the first one, it says QTD, that's first quarter is what that is. And then you can see your portfolio against the benchmark. And it says blended, but that's the Russell 2500 value. That's the benchmark. So the third line down just shows you the excess return of your portfolio compared to the benchmark. And you can see in the first quarter, the portfolio slightly outperformed, a benchmark that was down almost 6%. Let me give you a quarter-to-date update. For the second quarter through yesterday, your portfolio was down about 1.5%, which was slightly ahead of the benchmark on a second quarter to date. So far this year, the portfolio is slightly ahead of a benchmark, which is down about 6 or 7%. And then you can see for 2024, and then more importantly, going back 3 years, 5 years, 10 years since inception, the excess return anywhere from kind of 150 to 300 basis points. I think one of the things I always like to point out on here is when you outperform over the long term, a lot of what drives outperformance is not necessarily the things you do really well, but it's the things you avoid. And so managing risk means when you underperforming but not digging such a hole for yourself that you can't get out of it. And so if you want to flip back to page, let's see what page it is. Page 16, this shows you, and again, we've been managing portfolios for you for over 20 years, which, obviously we very much appreciate that. We appreciate the consistency and kind of the trust you've had in us over time, and you've experienced a lot of ups and downs, but again, over time, about 200 to 300 basis points of outperformance. But on page 16, you can see this year by year, and I think if you kind of go back the last, 15 years, you can see that we've underperformed, a handful of times. Every manager does. But it's been, smaller numbers, so 170, 135, 129, 400, or 90, 38, 36, going back, kind of through the past 10 or 15 years. And that's what we try to do is, so if you can manage your underperformance to kind of keep it to a limited number, then you have a few years like 2020 or 2017, and you can put up the numbers that we've been able to put up with. So that's what we try to do in terms of our risk management is we're putting together a well-diversified portfolio. If we underperform, try to minimize that underperformance, and then every few years things really start to click and you put up a big number. And that's kind of how we've been able to do it over time, and that continues today. So with that, I will kind of wrap it up. I know you've got a busy schedule, but I'm happy to, back here in the book, we've got the holdings. Actually, on page 7, real quick, I'll hit, if you can backtrack a little bit. Yeah, so again, this is just to share this with you. We don't manage to sector weights. We're out there just trying to find individual companies that we think can outperform. But you can see kind of where it stacks up today. And as I mentioned earlier, there's not a lot of turnover. So this doesn't look that different than what it looked like a year ago when I spoke to you. I think turnover this past year has been a little bit below average, about 15%. So this hasn't changed much. But you can see where we're finding value today. The areas we're finding the most value are in industrials and information technology companies. And the areas that we're finding lesser value is utilities. I talked about why utilities have outperformed. One of the things about utilities is the government regulates utilities, and so you're allowed to make some money, but they keep you from making a lot of money. Once you make a lot of money, you got to rebate that back to your customers. So we think there's a cap on kind of the upside for utilities. We've been underweight there for several years. And then you can see a few other sectors like healthcare where we're underweight. But again, just to reiterate, we're not sitting around a table saying, hey, we think IT companies are where we need to be. Let's go buy IT companies. We're not saying let's avoid utilities. What we're doing is just going out and finding individual companies that we think can outperform, and that becomes your portfolio. So with that, again, I'll wrap it up. I'm happy, through the rest of the portfolio or through the rest of the book, you can see different pages in terms of the positioning of the portfolio on page 9. You can see kind of some of the characteristics of the portfolio. I mentioned valuation. I think this really highlights that. If you think about the valuation, historical PE of the small cap universe, 13.9 is very low. And so, historically, they've traded kind of 16, 17 times earnings, and we're significantly below that. And if you look at large cap right now, it's roughly 20 times. So small and mid cap continues to be very good long term, and at some point it'll turn, and it'll turn sharply as it has in the past. And return on equity, these companies are still putting up good numbers. If you can put up double-digit return on equity and you're trading at 13 times earnings, that generally turns out very, very well in the long term. So I will leave it at that. Any questions I can answer about the organization or the portfolio?
Anyone have any questions this morning?
Great job.
Well,
Great
again,
job,
we appreciate
yeah.
it. 20 years is a long time. In this business, everybody's time horizon gets shorter and shorter. It used to be, long term was 7 to 10 years. Now long term is kind of 2 to 3 years in a lot of people's viewpoints. So y'all really know what long term means and have stuck with us through some periods that have been down, and I think it's paid off in the long term. So we really appreciate that.
All right, well, thank you for coming in.
All right. Thank you, everyone.
Have a good one. Okay, moving right along, that takes us to item number 5, which is the consent docket. We can approve that with one motion. We have a motion and a second. So please record your vote. Item is approved. Item 6 is to ratify approvals. We have a motion and a second. Please record your vote. Item is approved. Item 7 this morning is to approve the claims docket. I have a motion and a second. Please record your vote. Item is approved. Item 8 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item 9 is to approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 10, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. We have a motion and a second. Please record your vote. Item is approved. Item 11, receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. We have a motion and a second. Please record your vote. Item 12 is to approve the following applications of vested rights. We have a motion and a second. Please record your vote. Item is approved. Item 13 is items for individual consideration. We have one item. Item A is to approve the document conversion and scanning services using the City of Oklahoma City's purchasing contracts to convert the employee retirement system historical paper files for active employees, retirees, and vested employees for an electronic record system, estimated cost not to exceed $40,000. Anyone have any questions? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. That brings us to item 14, which is to receive the investment consultant report. 14A is the monthly investment report. Patty?
Good morning. I'll focus on the April monthly report first, just because there's been so much news in the markets for the month of April, and then kind of go back and just touch on a few pages in the quarterly report. You know, as we all know, markets have been significantly impacted by the tariff announcements that came on April 2nd, which Donald Trump dubbed as Liberation Day. And those tariffs that were announced were far greater than most had anticipated or expected. And as a result, markets sold off pretty dramatically. And then a week later, on April 9th, we saw a pause in those tariffs. And markets from that point forward kind of bounced back and finished the month. The S&P 500 finished the month down just around 4.9%, and you can see that on the chart here on the left-hand side of the page. At one point in time, the markets were down around 16 to 19%. We saw the same thing happen in the fixed income markets too, where we saw some pretty extreme volatility in yields and the yields dropping pretty precipitously. And then once the pause came on the tariffs, markets rebounded, and the S&P or the Barclays aggregate finished positive for 40 basis points for the month. But a lot of volatility, a lot of moving pieces going on. As Trey mentioned, you know, markets don't like uncertainty, and that's what really has created all this volatility in the markets. In addition to that, we also had a GDP report that came out that where economic conditions contracted about 30 basis points in the first quarter. And a lot of that was due to the net exports declining and net imports increasing. Consumer spending was still positive, business investment was still positive, government spending was down a bit, but net exports really contributed to the contraction with respect to GDP. And then in addition to that, we also had an inflation report that came out, which was a little bit better than expectations, primarily due to decline in energy prices. And then also unemployment came out last week, and the numbers were a little bit better than expected as well from the jobs report. And unemployment stands at 4.2%. And then yesterday, the Fed met and announced that they would hold rates steady. And a lot of that has to do with, we've gotten some positive economic data in terms of the inflation and unemployment report. You know, as a reminder, the Fed's job is to try to maintain inflation or to keep inflation around 2%, but also make sure that we have full employment. And at this point in time, while there's a lot of uncertainties in what impact the tariffs might have on future inflation, we haven't seen that come to fruition yet. And so the Fed is looking at a lot of the historical data while also taking into consideration what might happen in the future. And so they announced yesterday that they're keeping rates steady, while which is what the market had also anticipated and what the market was pricing in. So we didn't see huge market reactions yesterday, but now on a go-forward basis, markets are pricing in some cuts later on in the year, again, in anticipation that the tariffs are going to drive up the prices on goods that we're purchasing, which will increase inflation. And then they're pricing in that the Fed will come in and have to lower rates a bit to help fight some of that inflation. So it's pretty, you know, it's a double-edged sword and a lot of moving pieces, a lot of uncertainty. But in the end, at this point in time, the economic data is fairly favorable in terms of inflation and unemployment. The other big thing that's taken place this year is the dollar. So we've seen the dollar decline, which for the past 10 years, you know, prior to 2025, the dollar has been strong. And we see this come and go in pretty long market cycles. And so as a reminder, you know, a strong dollar is not beneficial to U.S. investors investing abroad. So when you take your dollars and you invest them international, whether in developed or emerging markets, when the dollar is strong, you're losing some of your return because of the strength of the dollar. Well, the exact opposite has occurred so far this year. Today, you see on this page, the MSCI EAFE is up 11.8% on a year-to-date basis. Most of that return, almost 70% of that return, is coming from the decline in the dollar. So we've seen the dollar come down about 9% on a year-to-date basis. And when you look at returns on a local basis or a local currency basis, the MSCI EFA is up around 3.8%. But when you take that and translate it back into dollars, you're getting 11.8%. So we've seen a nice tailwind on the non-U.S. equity side, both on international developed and emerging markets. And when we look at your portfolio results, you'll see that in terms of returns. So while there's a lot of noise and a lot of negative news surrounding the tariffs, by having a broadly diversified portfolio and having exposure to international and emerging markets, as well as private credit, private equity, private real estate, your portfolio is a little bit more insulated and the diversification has helped, which is the exact opposite from the prior 2 years when technology and large cap stocks have been doing a run up. They were really carrying the market. So things have changed. Diversification is helping, and we'll see that when we look at your portfolio results. Maybe moving forward to page 4. This shows where we are at the end of April. Portfolio was valued at $882 million. Large cap equity slightly overweight. Again, the target there is 15%. You're currently at 20%, but your target allocation to private equity is 15%, and you're currently at around 10%. So that extra, those other dollars are being held in the large cap space. Small cap target allocation is 10%. Non-U.S. equity in total is 20%. That's 15% target to international developed and 5% to emerging markets. So that 20% allocation has helped performance in the first half of the year. Fixed income target is 25%. You're slightly underweight there at 23%. And then real assets target is 15%, and you're just under 14% on the real estate side. We did make a recommendation this week to raise cash, so we need to raise some cash for future benefit payments and capital calls for private equity. We made the recommendation to raise $15 million from the State Street S&P 500 Index Fund. That's because equities are slightly overweight and fixed income is a little bit underweight, so we made that recommendation to take those dollars for the next couple months from U.S. large cap equities. Moving forward to page 5. Here you can see results for the total portfolio, over the various time periods. For the month, portfolio was relatively flat, but year-to-date, portfolio is down around 65 basis points on a net of fee basis versus the policy index up 40 basis points. And when you look at the underlying components to the portfolio, you can see international developed up 9.3%, emerging markets up 2.5%, fixed income up 2.9%. Private equity is relatively flat. You have to remember private equity is not mark to market on a monthly or even a quarterly basis. There's a lag there. And so when you look at private equity on an ongoing basis, because it's not mark to market on a regular basis, that will help insulate some of the noise or some of the uncertainties that we're seeing in the market and some of the decline. And you can see over the 1-year time period, that's more reflective of the private equity portfolio, up 11% on a 1-year basis. The other important thing to note too is real assets. That includes your private real estate. So real estate, kind of peaked in 2002, struggled or was down in 2003, 2004, but we think that's probably hit the bottom. And in the first 4 months of the year, we started to see things unthaw, so to speak, where we started to see more transactions, more liquidity in the market. Although kind of in mid-April, we started to see that freeze up again, again because of the tariffs and the uncertainties. But we have on a year-to-date basis, we have a positive 1% return on real estate. And longer term, over 5 and 10 years, positive return of around 5%. So you're getting that premium to fixed income. U.S. large cap equities are the laggard, down 4.9% on a year-to-date basis, but still over longer term time horizons, double-digit returns over 3, 5, and 10 years. And then small cap, is down 13.4% over on a year-to-date basis, and then 3 years up just under 2% at 1.7, but longer term 5 and 10 years up 9.7 over 5 years, and 10 years 7.8%. Any questions on any of the components of the portfolio?
You mentioned underweight and overweight. So right now we're underweight on PE and overweight on large caps by that 5%. So the overweight in large cap, are we just waiting to allocate that to private equity when those commitments are due?
Yeah, so the private equity allocations and the commitments are funded over time. And so we have done, private equity pacing plans to show how that will be called over time. And in addition to that, there's distributions coming into play. And so we've seen a little bit more activity in the private equity markets for the most recent period. But yes, essentially, that will be funded over time. You can't just fund it immediately.
The time frame when those funds are due, is it too risky to have that 5% sitting in a volatile asset class like the U.S. large caps?
It's actually it'll be over the course of a few years. So over time, it pans out. It's okay.
Okay.
No major concerns there.
Okay. Thank you.
Mm-hmm.
Anyone have any other questions for Patty on the monthly report?
I did want to mention one other thing in terms of one of your investment managers. So Harding Loevner is an international development manager. They currently invest, you are currently invested in a mutual fund vehicle, and they have recently launched a collective investment trust. So it's just a different investment vehicle. It's the same team, same process, same strategy. And we have worked with them, and they have offered our clients a reduced fee for going into this commingled fund vehicle. And so as part of that, our recommendation is to move out of the mutual fund vehicle into the collective investment trust. No changes to the strategy, same exact team, but it will save the portfolio roughly $70,000 to $90,000 per year based on the assets in the fund. So currently the fee is 73 basis points, and then that'll go down to around 58, maybe 61 basis points, again, depending on the assets. So we're going to work with Jenna to get the documents to begin working on that, and then work with her on transitioning that from a logistical standpoint, just moving those assets into the different vehicle. So wanted to share that good news with you all.
Okay, thank you. Okay, Chair will entertain a motion to receive the monthly investment report. I have a motion and a second. Please record your vote. Item is approved. And item 14B is the quarterly investment report.
Yeah, I'll just highlight a few pages in here, as this hit is already so stale, but maybe if you flip to page 20. Here we have we put everything into dollars, so on the monthly report, a lot of it is in percentage terms, but here you can see you started off the year at $900 million. Net additions, that's money coming in minus money going out. You see negative 9.8 million, and the return on investment slightly down around $6 million, with an ending market value of $884 million. But look at the longer term numbers, and I think it's always important to reflect on this, that, the pension plan is a long-term portfolio, and when you look at the long-term growth of the assets, it's pretty substantial. If you look at the 5-year column, you'll see you had started with a market value of $674.8 million. You had roughly $158.5 million leave the portfolio, but the return on investment is $367.8 million. And so again, it's just a reminder as to why it's so important to stay focused on the longer term. And while we have a lot of unknowns going on in the market today, your portfolio is broadly diversified and is structured so that it can withstand some of these different things that are happening and taking place in the market, and so that you don't have to react, to some of the things that are going on in the short term. You're able to kind of withstand that. So it's important to not only focus on the returns of the portfolio, but how much risk are we taking? What is the portfolio doing in a downturn? Are you participating in the positive market environments? And so on page 21. You see that. And so you can see over longer term periods of 5 and 10 years, the portfolio over 5 years has generated a return of 9.6% versus, the target of 7%. And then also, in line with the policy index, a little behind. Policy index up 9.8, but very strong return on an absolute basis of 9.6%. And then you have less risk. So we talk about the volatility. So you want that number to be a little bit lower. So you have 10.3 versus 11. That's saying you have less risk in the portfolio. And then we also have what we call beta, which measures the sensitivity of the markets. Again, you want that to be less than 1. So you can see the portfolio is at 0.9. And then also, are you participating in the positive market environments, and are you protecting in the negative market environments? And so lastly, we show what we call down capture ratio, and you can see, your portfolio, if the market was down 10%, your portfolio would be down 9%. So you're protecting in some of that negative market environment. And Trey kind of alluded to this during his presentation. He said if you can protect some in the downturns, but able to participate in the upside over a long-term time horizon, it benefits the portfolio and the growth of the assets. And that's exactly what you guys have done. And over 10 years, you can see portfolio's up 6.6, a little below that absolute return target of 7%, but meeting all the other investment objectives.
Okay. Anyone have any questions on the quarterly report? Hearing none, Chair will entertain a motion on item 14B.
Thank you.
Thank you, Patty. Have a motion and a second. Please record your vote. Item is approved. Item 15 is comments from board members, staff, and citizens. Anyone have anything this morning? Nothing? Okay. We are adjourned at 10:36. Thank you, everyone.